As we debate where bonds could go from here, one of my next guests warns that yields will shoot higher next year. Let's bring in Jim Bianco, president of Bianco Research, and Nancy Tengler. She's here on set with me, and she's CEO and chief investment officer of Laffer Tengler Investments. Welcome to everybody. Jim, you can just tee things off here with what's becoming what was a consensus call maybe a month ago and suddenly is out of consensus. But you're sticking with this idea that bond yields could yet go higher.
Yeah, I've been that way for 3 years, and I don't think that the move that we've had right now is over. I actually think we're in a multi-year bear market in bonds. It started in 2020. Usually, you get a recession or a serious downturn in the economy because something breaks. Either it's spiking crude oil prices or a pandemic or a financial crisis or something like that. This time around, everybody thinks the thing that's going to break the economy is high rates. But more and more, the evidence is high rates are a drag on the economy. They're not, helpful in some areas, but they are helpful in other areas because of interest income, and I don't think it breaks it. So I think what we're going to see for the economy for 24 is what we saw in 23. We'll churn out 2%, 2.5% quarters like we have been. I don't think inflation makes it all the way to 2%. We're going to have strong nominal growth, and I think that bond yields can probably see 5.5% somewhere in 2024. So the move down so far has been surprising and painful if you've been on the bear side like I have, but I still think the broader trend is still higher for rates.
Nancy, it's one of these things with the macro where you could almost completely ignore it, except for all of the extremes that we've been through. Even the bond move has been dizzying for a lot of investors. Where does it leave you kind of positioned into next year?
Well, I certainly agree with Jim's view in 2020. We argued then that bonds were riskier than stocks. But now I'm drawing an analogy to the 1990s when I was not only alive, but I was managing other people's money. And there's a lot of similarities. And you don't really need to see rates go lower. We were at 5 to 8% on the 10-year during the entire decade.
Wow.
We don't need to see inflation go back to 2%. And I agree with Jim. I don't think it will. We were at 3%. There was an inverted yield curve, a soft landing, a war, a recession. I mean, there was just everything that you needed. And one of the most important things was the VIX stayed under 18 for most of the decade while the stock market roared. So I think we're slowing. I don't know that we're going to get a recession, but I want to own those reliable growers going into a slowing economic environment.
I was reading some trader commentary this morning, and the tech traders kind of have their head in their hands. Now, maybe today a little bit different story, but we haven't really seen the performance from the Mag 7, for instance, that we were able to rely on. Does that affect you that much, or is that some take it as a healthy sign into next year?
I think it's both. I think you want to use the weakness, the recent weakness, and if we get further weakness to add to those names, because the generative AI total addressable market, I just gave a presentation on the fourth industrial revolution. You need to own these stocks in your portfolio. If the market broadens out, I mean, that's good for every portfolio manager because we have to be diversified. So I think our theme is old economy companies that are embracing the digital revolution, generative AI, cloud computing, and then the suppliers of the tools you need to get there.
But you're sticking with Microsoft. You're sticking with Adobe. You're sticking with Broadcom, names like that.
Yeah, well, Broadcom's reporting today, so I'm going to hedge myself. If it goes up, it's one of our largest holdings. If it goes down, you want to buy more. It's the poor man's NVIDIA, and I think you want to own that stock.